Hey there, tax fans. Welcome to State Tax Talks with me, your host, Joe Tantillo. I'm a tax attorney at the Hodgson Russ Law Firm looking to explore the nuances of state and local tax law. Here on the show, our goal is to keep tax informative, simple, and fun. So if you're ready to talk tax, turn up the volume and dive into this episode of State Tax Talks. Ladies and gentlemen, welcome back to another episode of State Tax Talks. I am Joe Tantillo. We're picking up where we left off last time with Joe Endres and Craig Reilly discussing sales tax issues related to sales of software as a service. Let's go back to a point that I kicked down the road earlier about Nexus. And we've got a whole episode on sales tax Nexus. If you haven't listened to it, it's a great listen. Go out and we do a much deeper dive. But, if one of you wants to kind of briefly recap Wayfair and why these companies that are just selling over the internet, have Nexus in a lot of places where they don't have physical presence, I think that would be beneficial for this conversation in particular.
Sure. So just very quickly, prior to the Wayfair case in 2018, you had to be physically present in a state in order for that state to expect you to comply or force you to comply with its sales tax rules. Following Wayfair, the Supreme Court said, well, that doesn't make too much sense now in the way that we do business and how ubiquitous the internet is in selling products. So we're gonna change the rule. You no longer need physical presence. Now your economic presence. If you make enough, sales into the state, that can create a obligation to comply with that state's sales tax rules. The problem with the Wayfair case, unfortunately, is that they didn't give us a uniform standard, one rule, one threshold that would apply across the country. Instead, the Supreme Court left it up to the states. And since 2018, the states started adopting these economic nexus thresholds where if your sales into that state exceed the stated amount, you have nexus and you have to comply with that state's sales tax laws. Now, every state now has passed, every state that has a sales tax has passed an economic nexus rule. So all states have a threshold. They range, most of them are at $100,000. So kind of my initial gut check is if your sales get above $100,000 into a state, you need to worry and think about it. But it gets even more complicated than that because $100,000 when? Is it calendar year? Is it rolling for a quarter year? Is it something else, some other measurement period? So it gets complicated, unfortunately. But, bottom line, kind of rough justice, if your sales are above $100,000 in a state, you need to start thinking about this.
And is that gross sales? Does that take into account sales for resale or a lot of other factors that come into play?
We have whole charts that answer that. The answer is it depends, as with almost all things sales tax. But some states are retail sales, which means taxable sales. Other states are gross sales. Some states are sales of tangible property, which excludes sales of services. So you just have to know the rule in the jurisdiction that you're concerned with.
And I'll add, I think the most specific or relevant nuance with regard to economic nexus rules as it applies to software as a service is, as Joe mentioned, these new economic nexus thresholds depend entirely on, regardless of how it's measured, your sales into that state. Are you doing enough business? Are you sending enough product into a state such that you've triggered economic nexus? You've surpassed these thresholds, however they're measured. If you're selling widgets, it's pretty easy to determine where your widgets are going and where your sales are going to be sourced. You can just look at the delivery address and say, all right, I sold $100,000 of widgets that were delivered into North Carolina. So if North Carolina's economic nexus threshold is $100,000 of annual sales into the state, well, I have economic nexus in North Carolina. In software as a service, you then have the added wrinkle, the added layer of you also need to know how you're even going to source your sales, because we are, again, talking about a license to access software that is hosted on some server that could sit anywhere in the world. generally the server location is irrelevant. So you are not going to determine whether you have surpassed economic nexus in state A or state B based on whether you as the vendor are uploading or maintaining your software on a server in that state. Instead, because generally sales tax is a destination tax, you're looking at where the sale is delivered. How most states will source software as a service is based on the user location, is where is the license eventually being used. At the individual level, generally, that's going to match the billing address. There's not a lot of nuance. There can be, but if you have one license, one user with a bill to address where you're getting your personal license for Adobe, for example, all right, we can probably figure out how to source that sale. But business licenses, where you may have the bill to address in one state, but you may be acquiring a license with thousands of seat fees associated with it spread across dozens or hundreds of offices across the country, then you, in addition to even knowing what these economic nexus thresholds are, you need to know, okay, I have a $100,000 sale. How am I going to even divvy that up between all these states to know whether or not I have a sale into the state that needs to be added into the economic nexus threshold bucket?
Yep. When I think of software as a service, I think, there are three big issues that come up. We've already talked about, two of them. One is, it's software as a service. You can sell anywhere at any time. You could be having to deal with 20 different jurisdictions. So you got to know the rules there. Two is, okay, well, but which jurisdictions, as Craig just went through, the sourcing issues, what goes to where? How do I source the sale? And once again, unfortunately, there's just no uniformity there across the states. Craig mentioned most states are destination states, but there's wrinkles even within that. Some states allow, there's actual exemption certificates or, certificates that you can get that say, hey, customer, you're in a better position than me, vendor, to know where this is actually used. So we're going to exchange an exemption certificates to get me off the hook so that you can pay use tax properly once you really understand where everything's being used. So some states take that approach, and normally the sales tax is imposed on the vendor to collect from the customer. But in these instances, because the customer has the better information about where the software is being used, the onus of compliance goes to the customer. Other states, will take a more, generally speaking, will take what's the bill to address? That's the default. I mean, on audit, most auditors are going to say, let me see the invoices at issue for someone who's selling software as a service, and they're going to source them to the state where the invoice is going, the address on the invoice. But the way that this usually plays out and how it comes up is, near the end of the audit, you have a list of transactions that are creating your liability, right? A list of transactions that are software as a service where you didn't charge tax or didn't properly charge tax. And invariably, in order to reduce that liability, the vendor says, oh, but wait a minute, that's not all a New York sale. A bunch of the use of that software is outside the state, and they bring up this issue. The problem with that is what's good for the goose is good for the gander, because then that immediately prompts the auditor to say, well, okay, fine, maybe that transaction is only partially used in New York, but what about all these other transactions? I didn't even look at these other transactions where the invoice address was outside New York. So if you're going to bring up that allocation between states, we have to do that not only for all the other New York transactions, but also for the transactions that are not, addressed to a New York customer. And that just can open up a whole can of worms. And you can be back to square one on an audit where you thought you were at the end.
Do you ever have situations where a business is getting audited by more than one state and the states are fighting over who gets the bigger piece of the receipt based on this issue?
I have not experienced dual simultaneous audits, but in planning exercises, there is always a tension in ensuring that you're not paying or collecting sales tax multiple times from multiple jurisdictions. Instead, in practice and on audit, I think the risk that I've experienced more frequently is what Joe described, which is I've spent a lot of time talking clients sort of off the ledge of saying, well, wait a minute, this New York auditor has picked up $1 million of alleged New York software as a service sales and is saying that I now owe tax on this $1 million total, but I know for sure that I've got users in that group or in that category that were not located in New York. And as Joe said, she said, well, you know what they're excluding? They're also excluding $10 million of sales that are billed to other states. What percentage of the users associated with those contracts might be in New York? Because let's be careful here. We don't want to sort of ask for too much and open up Pandora's box.
Lots to consider. Let's move forward from the sourcing piece and kind of talk again about taxability. We mentioned that New York looks at this as sort of a sale of a tangible personal property, notwithstanding all of the caveats involved with that. Is that the most common approach amongst states in your experience, or is there more states that are viewing software as a service actually as some sort of, non-taxable remote access service? I mean, based on what you've seen and the research you've done has become the most prevalent?
I think the most prevalent is still probably the tangible personal property approach, simply because it was the easiest to, effectuate. Meaning, all you had to do was do what New York did: add software to the definition of tangible property, and you're kind of where you need to be. But as we've gotten, in more recent years, we are seeing states start taking more technologically based approaches to changing their laws and adding definitions that will be more computer based. Again, I'm thinking of like Connecticut with its computer services. But for the most part, I think most states do try to fit the SaaS model in an already existing taxable bucket. Again, Texas uses data processing. So you look for those kind of taxable umbrellas, and what can we fit this under?
Right. And so I'm a vendor who sells one of these software as a service products. Like, how do I figure out if I'm in jeopardy? Like, am I totally stuck with, New York says, oh, this is just software as a service, but pay us for this because it falls under this digital license transfer. What I'm getting here really is, primary function of these service. How do I figure that out? Do I figure that out independently? Do I need to be cautious in taking a position without consulting someone who has some expertise in this field? Because obviously you can kind of divide this up a lot of different ways based on what the user is actually making the purchase for, as with all sales tax transactions. But I think with software as a service, there's a lot more nuance to why a particular customer is purchasing the software that they're purchasing.
So that brings up just the last point. I mentioned earlier that there are three big issues in my mind when I start thinking about software transactions. The first is, again, lots of different jurisdictions. You got to know lots of different rules. The second is whacking up the transaction between those different jurisdictions, so the sourcing issues. But the third one is perhaps the most counterintuitive, because it should be the easiest. What am I selling? Mm-hmm. What is this product? Is it, in fact, a software product? Is that the primary function of this? And the reason it's not a straightforward analysis is because all software does something, right? It has functionality. And because of that, it gives you the ability to think, well, what's really going on here? Is it the sale of software, or is it the sale of a service? That's really what the functionality does. It does something, and that can be characterized as a service. So you have to distinguish between the software itself and what the software does. And there have been many taxpayers who have been successful contesting the fact that, New York or some states said what I'm selling is software. But in actuality, when you look at the transaction holistically and all the other elements to it, it's more than just the software. It's a service. And the reason this is important is because in most states, sales of tangible property are taxable unless an exemption applies. sales of services are not taxable unless they're one of the few that are specifically enumerated as taxable. And here, the services that the software is actually performing are probably not taxable because of that construct. And so if you can make an argument that this is a service, more often than not, it turns out that service is not subject to tax.
I mean, this goes back to the prevalence of software as a service and how ubiquitous this is in today's economy, because you can think of many examples of service providers that have some SaaS component to what they are offering their customers. But going back to the primary function idea, in sales and use tax rules, if the primary function of what is being sold is the service as opposed to transferring some possession and control over software functionality, it should be non-taxable. And as Joe alluded to, there have been a series of recent determinations, at least in New York, on this issue. I'm thinking of the matter of breakdown services, which essentially involved a casting agency. So this was the service that was being provided was an agency that would match, I think it was mostly on Broadway, but most Broadway performers with available roles. And so, but as part of that, so what they did was they brought together producers and performers. But as part of that service, they offered a web hosted platform where you could go in, you could upload headshots, you could upload your background, you could check for audition times. I believe you could sign up for auditions. So there was a significant amount of functionality involved in this web-based platform, where as part of the service you received, you could log into this web-based platform, play around with the software, achieve some level of functionality. And what the tax department said on audit was, well, look, what this vendor is really selling is a license to use software. We see some functionality. It's a web-based form. You pay for access to the web-based form. That's taxable. Here, the taxpayer challenged that determination, and the case got into a fairly detailed primary function analysis. And what the court had to look at, and this was an administrative ruling in New York, but was essentially what is really being sold. What are these struggling actors paying for? Are they paying for the ability to come in and play with software, or are they paying for the ability to have somebody find them a role to perform, which is not listed as a taxable service? And in this example, the court said, look, what you're actually paying for is the service of matching a performer with a production. That's not something that's listed as taxable. And yes, there's this form. Yes, there's this limited functionality, but it's not enough to turn this into a software as a service taxable sale.
And for our listeners, could you describe just a little bit of how the court analyzes that? How are they differentiating between the sale of a service and what the customer is actually buying? Because obviously that's where the nuance comes into play. And that's where, tax lawyers cut their teeth on these cases is knowing what to show the court to help them understand. I mean, for the listeners out there who have never litigated a sales tax trial, like, are you bringing in customers to go, man, I was just in it for the registration forms, but I had 10 of my friends who use this casting agency. They were just about, getting the Broadway show gigs.
Well, look, you are supposed to analyze transactions from the customer's perspective. There's authority that specifically says that. So when we're trying to apply the primary function analysis, it's really, what does the customer want? What is the customer paying for? But the evidence that you can bring to bear to support an argument that this is a non-taxable service is certainly multifaceted. It's not just the customer's perspective. They're looking at everything from what's the language you use in contracts and on your invoices. Are you selling a software product? Do you specifically use or sell a license to use the platform or the software product, or are you characterizing it more as a sale of service? The biggest things to me, I think the things that carry the most weight, one of the key function or questions is, can I complete this transaction without human intervention? If it's 100% automated, it makes it easier for the state. I'm not saying it's always software, but it makes it easier for the state to take the position that they're software. Whereas if a human has to intervene, that carries significant weight, that there is a service element to it. Similarly, how is it billed? Are you billing like you would a typical software product, number of seats, or just a monthly, flat fee? Or is there an element to it of time and materials, which is how you tend to see more service-oriented transactions billed? So, there's a whole, and none of them all line up perfect, right? It's usually a mix and match of those different, some favoring software, some favoring the service. And that's why it's disputed and heading to court. Those are the ones that you see there. But those are the type of things that you need to look out for in order to build an argument. Another big one is marketing. How am I selling it to my customers? That tells them a lot of what the customer is expecting to buy, because I'm trying to meet a customer need, and this is what my website says my product is. So all of that stuff can go into that analysis.
And there is, for better or for worse, I think a little bit of shooting darts in the dark in terms of where these primary function cases, and this is not just unique to software as a service.
Right.
The primary function question comes up in sales and use tax controversy a lot, and it is very fact specific. I think the litigation strategies that Joe just laid out, I agree entirely. That's exactly how you have to litigate these cases, and that's how we would litigate those cases. Yeah, but it is, in my opinion, hard to find a consistent, principled rationale across all primary function decisions that have been published.
I think that's exactly right. I totally agree. I think you make the best argument you can based on the facts you have, but there is no method or set rule that you can apply that says you win or lose.
And I imagine it's complicated further when you have multi-tiered subscription models that add various things as you pay more money.
Absolutely. And the one thing that I would add just on the before we leave the primary function analysis, the other way that I look at the question is, and we've seen some litigation in this area as well, where taxpayers have been able to successfully argue essentially, and this is, I sort of think of this as the cousin or the brother sister of the primary function analysis, but where vendors have argued, look, I am not even selling software at all. What I am doing is I, the vendor, am using software to perform my otherwise non-taxable service. So there it sort of becomes a question of possession and control, right? It is, yes, there is a software component of what I am doing. And the classic case I think of is there was that SunGard decision going back to, I think it was 2014, 2015. And there, SunGard, they're a financial consulting data processing firm. And they offered a type of loan valuation service where you as the customers could input a significant amount of data, you could get reports back. Initially, the auditors said, well, look, there's some functionality here. What you're really paying for is the software. And SunGard successfully argued, no. Our customers aren't even using the software. We, the vendor, yes, there is a software aspect to what we're doing, but they don't get possession over the software. They don't have control over the software. We use it. This goes back to the primary function point about the human involvement. They actually had personnel who were engaged with the software. Yeah, it was only available for limited hours during certain periods of the day. But their argument was successful, was we're not even selling software. We use the software and we use that software to spit out, and in this case, we can maybe get into the idea of information services in a second, which is a whole nother can of worms. But they argued successfully that we're using this software to provide, which would, in that instance, was a non-taxable personal and individual information service.
And that I was just about to say, in New York, this analysis is even more difficult because New York is one of the few states that taxes canned information. So information services are taxable in New York. Other states do tax information services, but it's not quite as prevalent. And so here, because anytime you're using software, you're using data, you're using information. I mean, that's what software essentially does, is it compiles, analyzes, and does something with data. And so there's almost always the argument that, no, this is an information service. And most of the software cases kind of take a look at the transaction from both a software perspective and an information service perspective. And if that information is personal to the customer, then it's not taxable. But if it's not, if the information is comes from a common database or is more like canned information, then it is taxable. So there's yet another wrinkle in New York and in other states that would tax information services that vendors have to worry about. Even if you're not a software provider and you have facts that support that, you still have to worry about, well, is this taxable information?
Yeah, I always like having the conversation in New York, at least, where it's clear that I see it in financial services a lot, where there's some type of platform that has a combination of functionality and data. So you are paying for a license to access some type of hosted database, but you as the customer are able to manipulate and play with the data. And in New York, at least, well, that's either a taxable information service or taxable software as a service. So you could sometimes say to your clients in that instance, this is really a distinction without a difference. If you want us to do some academic exercise here, sure, we can try and parse this out for you, but it's not going to make a difference in New York. But in plenty of other jurisdictions, it's going to make the world a difference, whether the primary function there is the software or the access to the data. In many other jurisdictions, that's the difference between a taxable and a non-taxable sale. It just so happens that in New York, distinction without a difference, but that's not true for other jurisdictions.
I think we could spend a lot more time talking about, the various nuances between the taxability, but I'm cognizant of how much time we have left in the episode, and I do want to dive into just kind of some audit issues that come up for businesses being audited, if they're selling this type of stuff. Folks, this is a great time to take a pause. We're going to pick up this discussion next week in the final episode in this series of sales tax issues related to software as a service. Until then, this is State Tax Talks. I'm Joe Tantillo, and we'll see you soon.
Thanks for joining us for another episode of State Tax Talks. If you're interested in listening to more episodes, we're available on all platforms where podcasts can be found, including YouTube. If you enjoyed this episode of State Tax Talks with Joe Tantillo, please give us a 5-star review on your favorite podcast platform. And if you're in need of a tax professional, you can contact the tax attorneys at Hodgson Russ. Go to www.hodgsonruss.com for more information. And until next time, I'm Joe Tantillo, and this is State Tax Talks. Catch you later, tax fans. The comments contained in this podcast do not constitute legal advice. The opinions herein are the opinions of the speakers and not the official opinion of the Hodgson Russ Law Firm.